Well, hello, this is RJ Kelly. I'm founder and chief visionary officer of Wealth Legacy Group here in lovely San Diego, California. I'm delighted to have my good friend and truly a mentor when it comes to all things real estate, Terry Moore, who's going to be joining us here in a minute. I'm going to, we are recording our event today. So, and we will also be having, let me just kind of put things on pause, show you something here in a moment. And let's take a look at sort of what we are up to today. So our plan for today is as follows. Terry's going to be sharing here for about 20 minutes the many factors that are making now a wonderful time to buy San Diego income property. It wasn't too long ago, maybe 2 months ago. And I challenged Terry on that because it seemed like cap rates were so low and other things. And then Terry sat me down as a very patient father with a ignorant young boy. So let me just walk you through some of the reasons why San Diego is still a terrific place to buy income property. When we finished that, it was like, okay, that makes really good sense. In fact, Terry, it makes such good sense. I think we should do a webinar on it. So that's what we got to today. I'll be sharing for about 15 or 20 minutes on how to make capital gains taxes optional. And not only capital gains taxes, but California income tax, as well as the little 3.8% Medicare surtax, and also perhaps give you some deductions that you may not have expected along the way. So we're in all of that without having to do a 1031 exchange. Then Terry and I will be taking some questions. Now on your screen, if you go down to the very bottom of your screen now, you should see a little chat box there. So as you're listening to Terry, as you're listening to myself, feel free to go ahead and send a message there, and then Terry and I will tackle those in our last 15 minutes, and then I will be wrapping up things in our last 3 minutes. So our goal would be to be done on the hour. I respect everybody's time. So let me and by the way, I just want to remind everybody, this is not what Terry and I do for a living. so keep your expectations way low, and we'll be just fine. So with that, let me just give you an introduction to both Terry and myself. Terry Moore, MBA, CCIM, ABR, is the only broker in the San Diego County to have earned what they call Triple Crown, which is the investment real estate brokerage world recognizes separate awards, both for the investment deal maker of the year, the advisor, the CCIM, which is, you're probably aware, that's like the CPA is for the accounting industry. JD is for the LLM is for a tax attorney. And so Terry was both the investment deal maker of the year. He was the CCIM recognized as the top professional advisor in the entire chapter, which is saying a lot. There are a number of really talented CCIMs in San Diego. And also had the transaction of the year. So he's a part owner of ACI Commercial, which is the county's most prolific investment brokerage and firm in town. And he's also an author of a wonderful book called Building Legacy Wealth. I've read it. I know if you haven't read it, you need to get a copy. It's just enjoyable and so thoughtful and so intelligent. And not only that, but he's got another book coming out. I'm not sure how soon, but I think pretty soon. He's also a past board member of the Apartment Association, both here in San Diego County Apartment Association Owners Advisory Board, and then also at the state level as well. So he's a giver. He has closed more than 400 income properties in his young career, and he's also formed more than a dozen group investments, been published numerous times, well over 100 times by various magazines and newsletters. Locally, nationally, he's also given a variety of continuing education classes for the local Appraisal Institute, California Association of Realtors, National Commercial Investment Real Estate Institute, the County Tax Assessor, and on and on and on, also, as well as National University and USD. When I bought my first apartment building, no offense to my broker at the time, but after I met Terry, who was representing the seller, I just couldn't help but sort of secretly wishing, gosh, how come Terry isn't my broker? Because so knowledgeable, so patient, and just everything you would want in someone representing you on the purchase or sale of an income property. Now, a little background on me. I've been in practice. I'm the founder and chief visionary officer for Wealth Legacy Group in lovely San Diego. We've got clients in 19 states and counting, but we are right here in San Diego. The practice is really multidisciplinary. We are a consulting, wealth management, tax, insurance, and legacy advisory group. I come at this because my father died when I was 18, and I saw what happened when an enormously successful business owner left some things undone. And even though they had done some significant asset protection planning and estate planning, there were enormous issues such that within 10 years, this multi-million dollar company was bankrupt. So that really prompted me to want to address the diverse needs of successful entrepreneurs, of real estate owners, professionals, and their families. Now, when I'm not with clients or speaking, as I do frequently, our Wealth Legacy Group tribe and I are developing comprehensive plans that maximize investment growth, they mitigate risk, create clarity in the family legacy issues and issues of philanthropy, and also facilitate business succession and exit strategies. And on top of that, I'm a co-founder along with Terry, Alan Niven, and Bill Exeter, a couple of other great friends of ours. And I'm executive chair of this nonprofit that we founded back in 2008 called the Center for Wealth and Legacy. We were going to do one event. We've done over 50 in San Diego and 5 in Las Vegas. We do 3 events a year called the Leadership Insights Forum. So hopefully we'll be able to share that more with you in the future. As I said, I've been in the financial advisory space for over 35 years. And we offer a complimentary 30-minute, just get acquainted. Let's talk about your situation, what you're trying to accomplish, and particularly also with your legacy and your philanthropy. And then just give you some candid feedback. And whether you hire us or engage us or not, doesn't matter. Just there, I love to make a difference in people's lives. Multi-generationally, you can reach me at rj@wealthlegacygroup.com, and the office is 800-975-5355. Terry's information and mine will both be available here in a moment on our PowerPoint slides. So let's see. As I mentioned, this is not what we do for a living, so hopefully this will now start. So Terry, can you hear us? There you are, you handsome devil you. I'm going to disappear from my picture, and we're going to I'm going to put some slides up here, and there we go. So take it away, my friend.
All right, thank you. I'm glad for the doc and the other 30 or 40 people who have signed up. Many of you recognize, glad that you're here. So I'll try to give you a drink from a fire hose effectively and hopefully not too quick. The point of my part is now is a great time to buy income property in San Diego. And so, RJ, I'm going to go maybe to the second slide, which is San Diego County apartment market over the last 30 years. Most of the time, things have gone up. 24 years have gone up. A few years, they've been about stable. And actually, a few years, 3 years, they've slipped in value. But over the last generation, the bullet points aren't keeping up with me. There we go. So over the last 30 years, we've had a phenomenally great run. And I think we're in kind of a stable year now, and we might be in a year that will slip. Part of what makes San Diego different than most other places is we have a phenomenally diversified portfolio. And that's one of the major themes that's been true in San Diego for, well, before I got in the game. In Vegas, in Tucson, in a lot of places you can get more cash flow, but when a recession comes, it hits hard. In San Diego, because of unique things about San Diego, we have smaller recessions and they end faster. For most of the last 30 years, when they've done studies of San Diego, it's been in the top 10, and part of the reason it's been in the top 10 places it's been best is because it's lower risk. The next slide mentions that I'm going to give you the highlights of 10 different articles that I've read, and anybody who signs up will get copies of these just because we've got your email. So on the next slide, I'll be really quick. There's a lot of reasons that people buy income property, leverage, tax shelter, cash flow, and others. And all those things are true. It is office, industrial, retail. But let's talk about what makes San Diego special, why it's a low-risk place. Government policies make drunken fools who own income property look good. The city, the state, and the county government have done things so that we have a huge demand and not much supply. In the last 30 years, we built half as many apartments as we need. If you happen to cash rent checks, that's great for you. If you happen to write rent checks, well, it's not so much fun. When you've got a greater demand than supply, that's a plus. Now, we're in a spot now where some people are moving home, whether they're 20 or 30 or 50, but there's still a huge demand. Whether it's 50,000 rental units short or more than 100,000, there is an immense demand. The San Diego County Apartment Association, I put down here more than 50,000 units short. One of my business partners said yesterday that the city of San Diego alone, which is about half the population of the county, said the city judges that the city of San Diego is 100,000 rental units short. And in the last 30 years, there's not been a single year where we built enough apartments and condos to take care of our kids or grandkids or nieces or nephews. On the next slide, with any kind of income property, you get a subsidy from the government. A lot of us who own income property, like my friend Bob, think we pay more than our fair share of taxes and not sure that the fire truck gets to our house 17 times faster, even if we pay 17 times as much money. But we do get subsidies from the government. There is this wonderful tax myth that your property building disappears in value. Well, actually, it probably goes up, but you get to write off the depreciation each year. And so that's a subsidy. You get to write off the interest, which is a subsidy. If you happen to invest in income property, there's a wonderful special deal that lobbyists in the courts obtained for us more than 50 years ago, 1031 exchange. You can sell your building for profit, and if you follow the rules, you can reinvest and not pay taxes. RJ is going to talk about is something other than the 1031 exchange, but a lot of us on the line are familiar with 1031 exchange, and it's a nice way to get a interest-free loan from the government. You still owe the taxes eventually, but if you die, there's a stepped-up basis, and you may disinherit the IRS, which often happens. But 1031 is an advantage that you have as a real estate investor you don't have anywhere else. And apartment owners have traditionally traded up to bigger assets instead of paying the capital gains. Why give $200,000 to the government when you can make that work for you? There's a fourth thing that makes San Diego County a low-risk place to invest, and that is we've got lots of people, and rather than paying taxes, they would rather pay slightly more for a bigger property than the guy who's got the fourplex. You know, they bought the property 10 years ago, and they've got $300,000 of profit. If they sell it and pay the tax, they give $100,000 away. They don't give it a thank you from the president and governor. But if they buy 5 units or more, they put all that money to work. And the tax-deferred exchange and the way the property ownership is arranged here is we've got, figuratively speaking, lots of little deals. We have 200,000 rental houses and condos. We have 5,000 fourplexes. When you look at the blue area, 5 to 10 units, there's roughly 6,500 of those buildings. So people who sell a fourplex, they can pay the tax or they can trade up. The guys who sell 5 to 10 units, they can buy 11 to 30. And you notice there's not quite half as many of those. And when they trade up to 50 units, the further up the pyramid you go, the fewer the choices. So that mob of people pushing against you, the salmon swimming upstream, is an extra peace of mind. It's an extra feather on the scale that pushes values up. On the next slide, the fifth thing, this one, I've got a separate graphic of the lunar module. And the reason that that's on there is the lunar module, they didn't know exactly what they were going to encounter in the moon, but they needed something, no matter what happened, it would stay stable. Well, San Diego is more stable than most of the rest of the nation. There's 40 states where you can get better cash flow, but there's a greater risk during those times. In some of the Midwest states that have cattle and oil and agriculture, you get a problem and it takes you a while. Oklahoma, for example, in recession, it took them more than 5 years to recoup the jobs, and it took us less than 18 months to recoup the jobs. We've got 8 drivers. An economic driver is something that we export. We export defense. We have the world's biggest military facility here. That's not going to go away. We export education. We have several major universities and a lot of junior colleges. We export tourism. We export travel. We export lots of things, biotech. We do 8 different things which contribute to the world. And when one thing is down, well, bars and hotels are down. Well, they're down everywhere. But biotech, we're still trying to figure out cures to cancer. We're still protecting against China and the Middle East, or at least trying to mitigate them. So other places are more vulnerable to recession, and San Diego is surprisingly, almost uniquely better diversified than the rest. The next slide. Part of what makes housing steady here is we have a lot of product which, figuratively speaking, is a little bit older. The ladies on the call would probably think a 1970s kitchen was great for grandma, but not for my house. Well, most apartments in San Diego County have the original kitchens and the original bathrooms. If things were built in the 1990s, that might be an old house, but that's the newest 6% of housing stock in San Diego County. For a long time, we built enough. And then in the 80s, we slammed on the brakes with well-intentioned growth controls, but those well-intentioned growth controls meant that our kids and our grandkids couldn't afford to live here. They had to move to more affordable places, and a lot of our apartments have not been upgraded. So in the time that I've been in the arena, we bought, our clients have bought a building, cleaned it up, painted it up, fixed it up, raised the rent, and sold it, rinse and repeat. That's been a traditional thing, and it's been relatively easy to make modest upgrades. We passed a rent control bill statewide. You can still do it. It's a bit more expensive, but still, most of our housing has the original kitchens and bathrooms, and 1970 is the most common year. So upgrading that is a good thing. In layman's terms, the rent control bill, you can raise your rent 7% without doing dramatic things, and 7% is probably going to be 3 times inflation for a couple of years. Some of us with silver hair would say over our lifetime, inflation's been 3%. A lot of people say it's been only 2% in the last 20 years, but inflation happened. So the summary of those slides is that San Diego is a low risk escalator to wealth. And because we are very well diversified, there's not much of a downside. Now, bad news is we're in a pandemic. Pandemic doesn't mean that we're all going to die in the next year. Pandemic means it's worldwide. You can't go any place and avoid it. And every premature death is awful. And whether we end up with 200,000, whatever the number is, it's a bad thing. However, for real estate investors, it's not so bad. For apartment investors, it's even less bad. The smartest people that I know think that we might lose 20% of our bar jobs and our restaurant jobs. And whether 10 or 20% of the hotels and motels never open again, I don't know. We're doing Zoom. If we were doing this a year ago or 7 years ago, we would be in some auditorium or we would be in a luxury hotel, and now we're comfortable in different places one-on-one. Well, San Diego County is a place where 95% of the tenants are paying their rents. The state, in its infinite wisdom, has said the landladies and the landlords are the lenders of first resort. You can't evict somebody for not paying, but most of us are getting most of our rent, and we've made arrangements with our tenants because of it. Now, a year from now, some of those tenants are going to get evicted. It's not going to be fun, but it's going to be true. But because we have such a giant gap, we're not going to be giving concessions. It might be that some people will have a credit blemish for a long time, and it might be that the landlords and landladies will have lower income this year than last year, but almost everybody's going to have more income this year than 2 years ago. In February and March, most of the apartment lenders spent most of their time making loan modifications. And in effect, if somebody's been a good payer for a long time, they would say, tell you what, we'll cut you some slack. You didn't cause the virus. You didn't cause the recession. Make it up in a year, or maybe we'll tack it on at the end of the loan, but we're not going to foreclose. And some of us who are ancient dinosaurs, like RJ and I, remember the
Careful,
RTC.
careful.
Okay, so RJ's grandfather told him about the RTC days when we lost more than 1,000 apartment buildings. In the last recession, we lost in 25. But essentially, we're probably not going to have, I don't even think we'll have 20 apartment foreclosures because of this recession. And most of the people who've got buildings, if they've owned it for 3 years or more, they've got more wealth than they've ever had before, and they've got plenty of cash flow, so they're not desperate. There's a lot of people out there who want to buy for 75 cents on the February dollar. And let's affectionately call those vulture buyers. Well, vulture buyers are interesting if there's desperate sellers, but the banks aren't foreclosing. So, well, they're not going to buy from the banks because the banks aren't going to foreclose. In the last few months, I've dialed 1,000 owners. I've yet to encounter one, not even one, that will sell for 95 cents on the February dollar. There will be a few situations where somebody panics or for whatever reason they had to do it. There's fewer buyers out there, but the fewer buyers is part of what makes this an especially good deal. When my dad was a youngster, his dad said, son, hit them where they ain't. And in baseball, he was saying, if you can go where there's not much protection, that's how you score. And this is my fourth real estate recession as an owner. And most of my better deals have happened in recession. I hate recession. I don't like anybody to suffer. I don't like the poor to suffer, the weak to suffer, the vulnerable to suffer, the old to suffer. Wait, I guess I'm old now. But anyway, a different note. RJ and I are each runners. He always finishes ahead of me. But when I'm doing the La Jolla Half Marathon, I go up Torrey Pines Hill, and I hate that hill. And I love that hill. Essentially, at the hill, everybody slows down. Well, the elite runners, the tall, lean guys, like RJ, they widen their lead. For us older folks or slower folks, we're doing good if we can keep our pace. And a lot of people, frankly, walk up the hill. Well, recessions are not much fun for anybody, but recessions and hills are times when the leaders can stretch their lead. As a broker, I've seen the number of offers that I've written drop by more than 90% in the last 3 months. Deals will still happen. I think we'll do a third of the deals in the next 3 months as we did from November through, say, January. But those folks who are in the game, they're going to capture the better deals. I can't use a time machine to get you back to 2010 prices, but I can get you in the time machine. You can buy at 2019 prices. One of my wisest clients, somebody I've sent to RJ, we asked Tom, what's the best time to buy? And no matter what year it is, he always says 5 years ago. If I can't run you back 5 years, but we can help you buy at last year's prices. So if you're among the few people writing offers now, you will find people who are showing some motivation. And there are a couple of other smart brokers involved with this call. And Doug, I'm not going to give your phone number. Gary, I'm not going to tell him how to reach you. But if you go with a competent agent and he or she actively promotes your interest, you have a chance of finding the few people who are motivated. I'm glad that you listened in. I hope we've added value to you. Part of the reason I'm still doing this is I'm hoping that I can create value, and I'm hoping that I can add value to people as they make the most important financial choice of their next decade. Thank you for your time. When time rolls around, I'd be thrilled to answer any of your questions. Contact information here. And if I can visit with you and add value some other way, let me know. Thank you for listening. RJ, I think it's yours.
Perfect. Thank you so much, Terry. As always, I learn from you every single time we're together. And as far as me passing you, it's probably more the other way around. And on top of that, I, as an 8-time marathoner, I have been passed by probably every body type that is out there. Short, fat, whatever. A lot of it's about heart. So, but I can say one of our goals, as you know, as any marathoner or half marathoner, is to finish the event the same day you started. And I can safely say I've done all that. Well, I have the great honor of getting to follow with Terry and the challenge of following up such a great presentation with something that hopefully this will be maybe some new ideas, some things you may not have seen before, or maybe a variation on a theme. But I'm going to talk about how do we make capital gains taxes optional. And we're going to be really short of time. That's not anything to do with Terry, but that normally this is a presentation that I give just by itself in 55 minutes. So here's my goals for today. I want to give you some tax smart alternatives for selling real estate. And some of these ideas are going to be ideas that your advisors have not seen before or are aware of. Fortunately, there's a whole bunch of tax attorneys and tax CPAs that I can bring you to that are familiar with this, so you don't have to pay your advisors to get educated. We can bring you to some of what are called super lawyers and the top CPAs in the country that are already intimately familiar with this. It was just on email this morning when I was working out with a wonderful estate and tax planning attorney friend of mine back in Alabama. So it's a nationwide network. I'm going to talk about how can you sell and defer, if not either eliminate paying taxes on your gain, at least deferring them for 20 to 30 years. And what do you do? Those are what I call fence at the top of the cliff strategies. And that's ideally what we want to do, is put a fence at the top of the cliff. But what happens if you do go over the cliff, or maybe you've already sold a property this year? Wouldn't it be nice to know that there's a net and an ambulance in the valley? So what can we do from a post-sale standpoint from tax planning? And there are ways in which we can probably eliminate all of the tax on the event. As I've already mentioned, we do offer a free 30-minute consultation to just brainstorm whatever situation, and maybe a pending sale, or maybe you've already gone over the cliff. So whatever you're facing, let's have a chat. Now, first of all, let me talk about a code section. We're very familiar, most of us, with code section 1031. It's a code section in the Internal Revenue Code that allows for the deferral of tax. Why? Why does it work? Because there's an intermediary, somebody like wonderful Bill Exeter of Exeter 1031, who holds the funds. And so for up to 6 months, this licensed bonded individual holds the funds in his business. So you don't recognize the gain because you're not actually getting the funds. Well, that's for 6 months. Well, there's another code section. It's code section 453. And not that I'm here to make you an IRS expert. I'm just simply here to say, you may not know it by that section of the code, but I bet you sure have heard of an installment sale, because that's what it is. And installment sales have been in the tax code virtually since the beginning of time, at least time of the tax code in the US. So installment sales by themselves are not anything sexy. You recognize gain as you receive payment. But what is sexy has been something that's been happening the last couple of decades. So again, this is not a new idea. So if your CPAs and others aren't familiar with it, no harm, no foul. We get lots of referrals from CPAs and tax attorneys. So I'm not criticizing, but if this is new to them, this is not exactly new information. It's been around for decades. In fact, the biggest one I've seen that I'm familiar with more personally is a $1.6 billion sale with Boise Cascade, but more in a minute. So let's go through a traditional installment sale. The buyer and the seller come to terms. They come to agreement on down payment, how the payment length, what the interest rate's going to be, and so forth and so on. It's all laid out in the sales agreement that Terry would help you with. And again, it doesn't eliminate the tax on the sale. It just spreads it over time as you receive payments. Okay, so nothing sexy. That is the 453 installment as we know it. But let's take it one step further, because there are now intermediaries out there that are willing to act not just for 6 months, but for up to 30 years. And there are lenders out there that are willing to make an extremely interesting loan that doesn't even show up on your FICO score. And so here's the way it works. We have an intermediary that makes a simultaneous sale and purchase of the asset, just as before. The buyer ends up walking away with the property as they had already planned. And so everything operates just the same way. It's just that we're using an intermediary to hold the funds. So simultaneous sale and close. And then the very next day, within 24 hours, there is an independent lender, most often a private equity group, I can tell you, that makes what's referred to as a limited recourse loan to the seller, meaning that the seller gets 93.5% typically of the net sales proceeds. I'll walk through the numbers in a minute. But again, it's what we refer to as a limited recourse loan. Some people call it a non-recourse loan. That's not quite correct. The lender agrees to only take payments from the intermediary. Okay, so from this person, not from the seller, that being you. So you don't have to worry about making interest payments. That's all done for you by the intermediary. And again, you got 93.5 cents on the package within 24 hours of closing. We've done so many of these now, but I always get the biggest kick because I'll usually get an email or a call from somebody who says, it really worked. I said, yeah, what were you expecting? So the beauty of this technique is severalfold. Number one, there's no pressure of a 1031. I don't know of you how many of you out there have done 1031s. I have. They're not fun. There it is. You got to identify your replacement properties in a very short period of time. You then have to close the deal up in the 6 months. And so it's not a lot of fun. In this case, using this technique, there is no 6 months to deal with. We don't have to worry about finding replacement property. In fact, I've got a case right now we're working on. We're selling an asset out of a corporation, which don't own real estate in corporations, folks. But this has been for 30 years, they've had it in their corporation. So this is the technique we're using for them. We're going to be able to sell the asset, not pay any tax for 30 years. The plan is right now is to sit on the sidelines for the next 12 to 18 months and just wait for some opportunities. These particular folks, very savvy folks, just feel that real estate values may be going down a little bit. And so they want to just be positioned if they find a great opportunity, and not necessarily in San Diego, although as Terry's pointed out, San Diego is a great place to be, but in case they want to be in Nevada or in Texas or some other part of the country, they'll have the cash in hand and they can do it, and they don't have to make this deal within 6 months. There's no reportable gain for up to 30 years. They get the cash now in their hands, so you could go buy more real estate if you want. But one of the other big advantages is that when you do a 1031, you carry over your basis from your asset. And for many, they've already depreciated much of the current property or a predecessor property. So that basis may not be a whole lot you're bringing over, but with this case, as Terry has taught me over the years, you really make your money not when you sell an asset, when you sell your real estate, but when you buy the real estate. So now if we're coming in with cash, we can make usually a much better purchase, and we get a fresh new basis to depreciate. But alternatively, you could use the money to start a new business. Or invest back in another business that's existing. It doesn't have to be a new business. Or you might choose to diversify it in a portfolio of stocks, bonds, and so forth. I can tell you that since that's part of what we do, that my accounts for all of our clients as of 2 weeks ago, and it's only gotten better, all of our clients are positive year to date on their returns. And in fact, for this quarter, my own retirement account is up over 24% net of all fees. And so, while I'm not saying that that's what you should expect in every situation, there's some good money to be made in assets other than real estate, as shocking as that might be. Now, so that's the first one. And I know I see some questions coming in, and we'll look forward to answering them very shortly. I'm going to introduce some philanthropy into the conversation, because this gives an opportunity to not only eliminate, not just defer, but actually eliminate the tax on a sale, and at the same time, even create some tax deductions. You heard me right. Not only can we eliminate the the tax, but we can also create some additional deductions. Well, what's that look like? Well, there's a couple of different approaches. And these ideas I'm going to share now come from the 1969 Tax Act. So we're not talking about anything really new. Again, these are things that have been in the tax code for decades. Just because your tax advisors haven't heard of it, or if they have, they haven't brought it up, don't blame them. Just come and sit and talk with us. But not only can we create incomes in some situations for up to 3 generations, so over 100 years, but it also provides asset protection. There's no tax ever on the sale of the asset. And as I've mentioned, you get some income tax deductions. So here's the story. Why would the government allow this? Because all of, those of us that wealthy, affluent Americans, we understand that we have an obligation to support the social well-being of the country. For all its flaws, and we got some, and some have been on display in those last couple of weeks, but for all its faults, it's still by far the best country in the world as far as where I want to live. And everyone I ever talk to says, yep, I'm going to stay here. Now, with that in mind, the government gives us a choice in how we support the social well-being of the country. So if we don't choose in advance, they choose for us. And what's that called? Well, it's called taxes. I like to call it involuntary philanthropy, but it is all in the same. There's federal, state, there's a bunch of other stuff. But if we choose in advance how we want to support the social well-being of the country in a way that's in alignment with our own value system, we can actually opt out. We can make those taxes optional. And that beneficiary can even be our own family nonprofit. My wife and I have our own family giving fund. And so we've been able to beam results into that account. So it doesn't have to be just somebody else's charity. It could be a charity that is one for you and your family. Again, generational. So how do you do this exactly? Well, first of all, you contribute the asset into an irrevocable tax-free trust. The buyer comes along and buys the asset out of that irrevocable trust. And we need to do this, by the way, in the advance. We are in the Ninth Circuit here in California. And so we need to do this far enough in advance that IRS could not come back, or more aggressively, actually, it's Franchise Tax Board, more often than not, it comes back and saying, wait a minute, this is a step transaction. You just simply set up this charitable trust to avoid paying taxes on the gain. So ideally, we need a couple of months in advance to be able to set up the structures, get things in place before a sale consummates. But we can certainly do that. Just can't be done overnight. Or as a call I got 2 days ago that's selling a $45 million company in New York. No, that's not going to work. You can buy more real estate. You can sell inside this irrevocable trust and buy more real estate. Just can't have any debt on it. And it can be income-oriented real estate or otherwise. And again, as I say, you can create a family giving fund to be the ultimate beneficiary of those funds when the 3rd generation dies, if in fact we're keeping it out that long. So how does that help? First of all, as I've already talked about, you got to set up in advance. It's a powerful tool for those clients that have real estate. If you have a private foundation, or if you've heard of a private foundation, private foundations and real estate do not play well in the sandbox. Unfortunately, I won't get into the tax issues, but you need to have a public entity to be able to work with, to be able to get the maximum tax deductions. And I've already mentioned, you can have an event. As a client of mine last year, unfortunately, they found us 30 days after they had sold their business and real estate for $7.5 million and created a $2.1 million tax bill to the federal government, the state, and to the Medicare Surtax. We were able to come along and save them $900,000. So again, we weren't able to wipe it all out, but we still were able to save $900,000 last year. We'll save them about $250,000 this year, and then next year as well. So that's pretty good stuff. And there is another second variation on a theme. Again, it's Code Section 453. It's called an intermediated installment sale. It doesn't go for 30 years, it goes for 20 years. It's best used in situations where someone wants income, but they are not wanting to necessarily have the flexibility in having the cash show up in their own account. So I've had families that have chosen to do this, even though it's for a shorter period of time. but were situations where they were afraid either their kids or other family members might come to them now that they sold their $10 million shopping center and had a whopping, $9.8 million sitting in cash. They were afraid that their kids or their folks were going to come to them and ask them for a loan, or say, gosh, I've got this wonderful new idea that we only need $5 million to get it off the ground. So as I say, it can be used to buy more real estate. It is more expensive over time than the idea I just talked about, the previous one, called a monetized installment sale, is what IRS refers to it as. This idea, this variation on a theme, takes less money out up front, so there's more money left to generate income. But over time, as I mentioned, it does become more expensive. This one is an idea I guarantee you your tax people will not have heard about or even know what this name is. It's an ugly name. I appreciate that. The technical term, a reversionary charitable lead annuity trust. What? So sometimes it's called a CLAT for short. I call it in terms of this particular tool, we're just using it in situations where you're already involved with a charity. Maybe you've had a taxable event, and what this allows you to do is to mitigate some of that tax. So for example, one of our clients several years ago, we set up an account to provide $50,000 a year to his own family giving fund. He chose to do this for 10 years. We put in $550,000 of assets at the time, projected 2% in income and 6% in growth. So in 10 years, even after having $50,000 a year go to his own family giving fund, which in this case was going to be used then for providing educational and scholarships, but at 2% income and 6% growth, the $550,000 is projected to be coming back at over $460,000. But here's the other thing. It generated for him over $400,000 of income tax deduction just in that first year. So what that did was help obviate or help offset the tax from another liquidity event where he had gone over the cliff and didn't have a fence in place. Interest rates are low, and that's where these ideas work especially well. And so I'm given the time that it is, I'm going to skip through this one. Although this is a terrific idea, it actually gives us international asset protection, and we can sell assets inside of it. We actually use a life insurance contract that's positioned offshore in one of the IRS approved international jurisdictions. We can access the cash in there as long as it's properly designed. Within 2 years of setting up the account, you have complete protection against any sort of creditors, not only here in the US, but it also protects on the 10-year federal bankruptcy look-back rules of 10 years, which normally if you set up asset protection trusts onshore, you still have to deal with federal look-back rules of 10 years. No commissions with these products. We operate them just simply by a fee. And so just to wrap things up, we talked very quickly about a 30-year tax deferred mechanism to recognize taxes 30 years from now. We've also looked at a couple different ways to completely eliminate the tax on the sale. And not only that, can give you some pretty significant tax deductions as well. There's a second form of where we can use Code Section 453 in either a 20-year or 30-year deferral. We looked at sometimes I'll call it a bounce back trust. Sometimes I've lately started calling it a Schwarzenegger trust, as in I'll be back, because you get the money back after 5, 10, 15 years, but you also get a massive income tax deduction. And again, this private placement contract is something that we can sit down potentially and look at for you. There's also some other techniques I just simply did not have time to talk about today, but I hope that this has at least wet your whistle and given you some things to think about. And if you want to set up a 30-minute complimentary conversation, there's our numbers and there's my email. So with that, I'm going to, let's take a look and see at what some of our questions are, shall we, Jerry? So,
I took the liberty of answering a couple of the real estate questions. I don't presume to know as much about capital gains as options as you are, but one person asked, why would people think apartments are better than houses and lower risk? Diversified risk is part of it. Huge demand for new rentals, and we built about as many houses as we need. And somebody asked about collections, and as near as I can tell, San Diego is better than most of the rest of the nation. Landlords and property managers are reporting that 95% of the money that's owed is being paid, and that seems to be better than most of the other cities in the national figures that we're hearing.
Right. And so you might unpack that a little bit more, because you, in one of your responses, you, in comparison to buying a single family dwelling versus buying an apartment building, or it could be a fourplex or something, you make the point in terms of the acquisition costs that apartments are far less. So would you maybe expand on that? Because I think that's very fruitful thoughts for our listening audience.
In many areas of the county, you can buy an apartment building for 60% of what you would pay for a home in that same area. And the biggest single cost that a rental owner has is her property tax. And if you're in University City and you buy a house for $800,000, you've got an $8,000 a year property tax bill for the house. If you could find apartments in this zip code, it might be $500,000, might be $5,000 for property tax. But in every zip code, the apartments are cheaper than houses in that same zip code. And so if you can cut your biggest expense by 60%, that's a good thing. In most county, let me use generic countywide numbers. If somebody buys a rent house in San Diego County, they might pay 20 times the annual rents. If they buy apartments in areas in San Diego, they might pay 15 times the annual rents. So you get more bang for your buck when you buy apartments than when you buy houses. And also, you get a lower set of costs with apartments because your property taxes are less. I have one provocative comment, and if anybody's interested, let me know and I'll send you an article about it. But for your home, where your kids are going to go to school, location matters. We want your kids to go to the best schools they can get into. One of my sage advisors, one of my sage clients said, you want to live where you wouldn't invest and invest where you wouldn't live. Huh? Essentially, leverage is more important for income property and for wealth building and for rentals and location. It's great that your kids get to go to good schools, but you don't get any extra credit if your tenants' kids go to great schools. You can subsidize your tenants by letting them go live in a place with great schools. You'll pay 20 times the annual rent for a beach location, and you might pay less than 15 in places 20 miles from the beach. So if you want to live there, you look for one criteria. If you want it to make you wealthy, or if you want it to give you more cash flow, it's not necessarily the same set of rules. For income property, leverage is more important than location. I didn't believe that 25 years ago, but hopefully I've learned something other than what I've learned from you in the last 25 years. The last thought related to that is La Mesa goes up at the same percentage as La Jolla. El Cajon goes up at the same percentage as Escondido and Encinitas. Del Mar goes up at the same percentage as Descanso. So I didn't believe that when I got into the business, but I've done the analysis 3 different times. And leverage is more important for an investor than location.
Absolutely. And Terry, why don't you go ahead and show your screen as well? I'm showing my screen here so that we can get to see folks here. They get to see your handsome face. We did have a question about.
Wait, do I have a face transplant? I thought I was going to use my own.
Let's see. Well, I'm seeing you as you are sitting in your home-based office right now. So.
Okay, good.
Yeah. One of the questions that came up is in terms of Section 8 tenants and thoughts on that. And I can say from our experience, frankly, with apartments, that we've been willing to accept Section 8 tenants, but we've also said to them that we need to see some kind of work or work opportunity, and which basically eliminates, frankly, most Section 8 tenants. But I know from some other clients that they do have Section 8, and of course, since the city in most cases is making the lion's share of the contribution, I've got some, as I say, some clients that have been find that a pretty attractive solution. But Terry, what are your thoughts on that? What do you advise for owners in terms of Section 8? Any?
Well, the government, in its infinite wisdom, the city of San Diego has said that you will subscribe to the voluntary program. You don't have a choice if you rent in San Diego. The city of San Diego has made it mandatory that you subscribe to the voluntary program. I've been a landlord for 40 years, and I know people who love Section 8, I know people who hate Section 8, but if you rent in San Diego, you take Section 8. There's no way around it.
Your stands or butts. Okay, well, there you have it.
And I have some people who figure out, okay, in my zip code, what are the rents that Section 8 will pay? And by golly, by sheer coincidence, I just happen to charge $75 more than Section 8 will allow. So if you're willing to contribute 30% and the difference, then you can rent from me. And amazingly enough, not everybody likes that extra $75, but the city does require that people accept Section 8. The good news about Section 8 is the first business day of the month, you get most of your money on time. And even with the city's program, there's still a shortage of rental housing and a shortage of Section 8 housing. So somebody who blows their Section 8 certificate, if they misbehave and they get booted out, they may not get back on the Section 8 entitlement. I don't dare say dole. The Section 8 check, they may not get back in a year or two. They may not get back in 5 years, but most of the people will treat it with courtesy and respect. There's scoundrels in every arena, including renters and landlords.
And we have found that because we have a particular heart for refugees, and my wife coming as a survivor of the killing fields of Cambodia. So over the years, we've had a particular heart for refugees that have come in and found them, for the most part, to be extremely good tenants. There are certain parts of the world that we are less enamored of some of the tenants, but for the most part, they're just simply good people, no matter what, and from every economic strata. Terry, one of the questions.
Let me quickly say something. Several of my worthy competitors are on this call, and many of us have learned that lots of rental owners have tender hearts. There's many owners who say, look, Lulu at number 7, she's a special case, and she's never going to get a rent increase, or she's going to get half the rent increase. Lots of owners privately cut slack to their tenants. And that's something that often happens. You had a different question.
I do. If somebody would please mute, I thought I had everybody muted, so.
That was me, but I'm sitting on it, so Andy will pick it up. Sorry about that.
Okay, so you're the culprit. I'm looking going, gosh, I thought I had muted everybody's calls when they came in. So, all right, we beat you severely about the Head and Shoulders. We do have another question now. Let me go back to where it was, and it had to do with, in terms of just, let's say that somebody was to put 25% down, and can you, off the top of your head, Terry, give us an idea in terms of cash-on-cash returns, what somebody might be able to get? Or
in 40 states, you'll have a positive cash flow. In San Diego, even if you buy a fourplex with 25% down, you probably won't have a positive cash flow before tax. Because you get to deduct interest and because you get to deduct depreciation, you may break even in the first year. By the second year, you'll have a positive cash flow. There's 40 places where you have positive cash flow, but because we're safer and because there's this huge demand, our prices cost a bit more. And so you won't have a positive cash flow for 25% down in San Diego County. Detroit, now there, if you want to buy things in Detroit and you can get it rented, you get positive cash flow. But San Diego, it's safer.
Sure.
You pay more for safety.
But of course,
question. I hate the answer, but it's true.
Yeah, and obviously that's where having rent escalation, to the extent that you're permitted to be able to increase the rents.
Most owners would love to be able to raise the rents 7% a year. I've owned in several other states, and most of the other states drool at the possibility of 7%. And Californians think it's awful that we can only get 7%. That says something about our economy. And most people buy reasonably competent things can get a 7% increase. Now, we used to have a few people who would spend $10,000 to $40,000 a unit, and they would raise their rents 20% or double them. But those were fluke situations. Those were 2 or 3% of the 2 or 3% of the landlords, and most people weren't raising their rents more than 10% a year.
Mm-hmm. One of the questions is, how often do we see 1031s from single-family residents into apartments? And
well, there's 200,000 rental houses and condos in San Diego County. I don't know. Maybe there's 5% a year. Maybe there's 10,000 that sell. And I'm going to guess something like half of those go into duplex, triplex, fourplex. Some of them might go into single tenant, triple net. Some of them might go into Delaware statutory trust. But relatively few people are eager to pay the taxes early if they have options, and they do have options.
Yes. And so to that question as well, certainly we've seen 1031s have been fairly popular, but for the reasons I alluded to in my portion of the talk, the fact that you're carrying over your cost basis and that there's frankly not as much product to find out there that's available for 1031, those are the reasons why we're looking for these alternative solutions that give you cash in your hand to be able to just go and buy a new asset, and also with a fresh new cost basis. So again, Terry alluded to a moment ago as well, something we call Delaware statutory trusts, which is what I sometimes call the good DST as opposed to the evil DST of a deferred sales trust. But with the Delaware statutory trust, you can sell an asset, use a 1031, and then it allows you to go into a pool of investment assets, of real estate assets, certain kinds that qualify, some that don't. But with the idea there, then you're just getting a nice income stream of 6.25%, 6.5% net, and most of that, again, in the early years is non-taxable. So that's a very easy way of using 1031 to get an income asset, but those are, let's say, more of a pool type of approach and not going to be into a single. Terry.
One other quick thing. I'm not as good as I want to be, but in my 25 years, I've never had a situation where we couldn't find an acceptable choice for a buyer who wanted to do a 1031 exchange. I've never found the perfect property, but I've never had anybody say, you couldn't find me nothing that worked. And people say, I wish it were prettier, I wish it were cheaper, I wish it were newer, but we've always found something that worked. If we had 5 years to identify people would like it better, I've never come up empty. I haven't come up with perfect.
So with that, seeing that we're coming up on the top of the hour here, I think we got through most, if not all, the questions for us. So thanks for those are some great insights, folks. Terry, as always, Terry Moore.
Be with you again. Thank you.
Great being with you. And this has just been fun for us. Let us know if this has been helpful. You'll be getting a survey later today from Olha, from a member of our staff. And just we'd love to get your feedback. It's really helpful for us to know how we did, if this was helpful for you and what specifically that was helpful. As well, if you want to have a complimentary conversation with Terry or with us at Wealth Legacy Group, gosh, great. By the way, thank you. I'm seeing a number of lovely texts coming or chat messages coming in, so thank you. But again, let us know if there's some other topics that you'd like to hear about, and we can be setting those up as well. In closing this, Wealth Legacy Group, I called our business that because we help clients with all aspects of wealth, but all aspects of legacy as well. And the true reality is that every one of us is leaving a legacy, whether we're worth 10 million, 100 million, or 2 million, or 50,000. You know, the reality is every one of us is leaving a legacy. And the question is, what kind of legacy are we going to choose to leave for our families and for our community? And it doesn't matter how badly you screwed up. There's a story told of two brothers that got caught for stealing sheep up in, I don't know, Wyoming or something. And to penalize them for their dereliction, they got branded with 2 initials, an ST on their forehead, and for sheep thief. And they just wanted people to know, hey, steer clear of these folks. Well, the one brother couldn't, over the years, just couldn't handle what the shame, the guilt, the remorse that he felt, and he eventually killed himself. But the other brother decided he would stick it out, and there were more than a few times he got beat up, but he kept showing up, kept helping people without being asked for or expecting anything. And over many years, he became truly one of the most beloved individuals in that village, in that community. And one day, many years later, a grandfather and a grandson were walking down the street. They happened to see this gentleman who by now was walking a little bit slower. But the grandson looked up at his granddad and saw the love and respect that was directed towards this older man. And the young boy asked his grandfather, says, "Grampy, what's the ST on the forehead of that man over there?" And the grandfather took off his baseball cap and kind of scratched his head. He said, "You know, honey, I'm not quite sure what that ST, but I think it stands for saint." So I'm going to leave you with a story, because we all have made choices in our lives that we wish that we had not done, or we wish we'd handled a different way. But guess what? Today is a brand new day. You get a choice on how your legacy is going to go from here out. Is it going to be a sheep thief, or is it going to be saint? So we all get a chance to make a lasting positive difference in our world. So whatever that looks like, I invite you to consider that. That's important to us as well. Thanks so much for honoring us with the gift of your time. And thanks for these wonderful questions and input. Terry, as always, I learned something from you, my friend, every single time we're together. You are a bright, shining light in our community, and just
Glad to be with you.
an ordinary human being, even more so. So with that, God bless, and go do something great to make a difference in the lives of others. Thanks for being with us. Bye-bye.